Okay, welcome to 20-2, where we are going to continue our work with merchandise inventory. In the previous section, we learned how to determine the quantity of merchandise inventory. Now we're going to work on determining our cost of merchandise inventory. So in order to determine our cost, we're first going to need to make sure that we have all of our purchases invoice information up to date and current, because our purchases invoices are going to show us how much we paid for each unit of merchandise. And that amount can fluctuate, obviously, based on how many we buy and if our vendor chooses to increase or lower their prices. So we do need to make sure that we have those up-to-date purchases invoices in order to figure that. Now, most businesses are going to use one of three inventory costing methods. The first one is something called first in, first out, or last in, first out, or the third one is called weighted average. So the first one we're going to look at is something called first in, first out. Our example business uses the most recent invoices for purchases to determine the unit price of an item of inventory. So the earlier invoices for purchase are used to determine the cost of our merchandise sold. Using the price of merchandise purchased first to calculate the cost of merchandise sold is called first in, first out inventory. Commonly, we refer to it as FIFO, okay? First in, first out. So what that looks like here is when it says that we have on December 31st a physical inventory of extra large medium beach totes. This model number showed that we had 18 units on hand. Using the first in, first out method, those 18 units would show a cost of $422. So essentially, if we have 18 on hand, we work backwards because these were the first ones in. So for 10 of them at $23.40, we get a FIFO cost of $234 plus the extra 8 that we need to get to 18 total. So we work our way backwards from the first ones that we bought. We consider those to be the first in, first out. Now, the opposite of that is something called last in, first out. Otherwise, we refer to that as LIFO. Okay, where we take our merchandise purchase last to calculate the cost of merchandise sold first. So last in, first out. And this method is based on the idea that the most recent cost of merchandise should be charged against current revenue. Again, that's the accounting concept, matching expenses with our revenue. So when we look at this, using the LIFO method, each item on the inventory records is recorded at the earliest prices paid. So the earliest prices for those 18 beach totes would consist of the 10 units in the January 1st one. The next earliest purchase, we did 6 on February 16th, so we would use all of those. And then our next earliest purchase was on April 17th, and we need 2 more then to get to 18. So when we do that, our inventory costing method would be $382.40. So you can see with this one, we start up at the top, or our last in will be our first out. So again, we have 18 total, so we start at the top and we have 10 of those. We're going to use all 6 of those, that's 16. And then we need 2 more from this batch that we purchased on April 17th in order to get to 18. And then we figure our LIFO cost at $382. Now that's a pretty, not a severe difference, but it's pretty drastic from where our FIFO amount was. Now we also have a costing method called weighted average, and using the weighted average means that we take the average cost of the beginning inventory plus merchandise that's purchased during the fiscal period to calculate the cost of merchandise sold. Essentially, we take the average unit price of the total inventory, and the average unit price is used to calculate both ending inventory and cost of merchandise sold. When we do this, the average cost of merchandise sold is then charged against current revenue. Again, we're sticking with that accounting concept of matching our expenses with our revenue. So what we do here is we take our total of beginning inventory purchases, which is 1,120, and we divide that by our total units that we have, which is 50. And we get a weighted average of $22.40. Because then we have 18 units left in our ending inventory, we take that times our weighted average of $22.40, and we get a cost of ending inventory of $403.20. Now, when you do weighted average, clearly it should be in between FIFO and LIFO. Okay, weighted average is going to be in between, and you can see that based on the numbers that we found so far for FIFO and LIFO. Now, the inventory method that's chosen by a company to determine the cost of merchandise sold does not have to match the actual flow of inventory for the company, which seems kind of counterproductive. So when you think about it though, a grocery store usually stocks to the back, meaning that if you could imagine putting cans in a shelf, in a grocery store, typically they move the stuff to the front and stock new stuff in the back, right? So your first good purchased are the first goods sold. So that's something called FIFO, right? Hardware, on the hand, usually stocks its new inventory in front of its older stuff because it's not perishable, right? It doesn't have to be used up. So if something runs out, they just push the stuff to the back and stock in front. That's called LIFO. Gas stations, on the other hand, all gas gets put in a large underground tank, and so you have no way to distinguish that. So typically, the actual flow is more weighted average. However, any of these companies that we just talked about can choose the type of inventory costing method they want to use. So the grocery store, even though the actual flow is FIFO, they could choose to do LIFO or weighted average. Same thing with the gas station. Even though their flow is weighted average, they could choose to do FIFO or LIFO. It's completely up to the company. Now, the cost of ending inventory, that's always something that we need to know so that we can figure out our cost of merchandise sold. Now, although the formula is going to stay the same, remember that under each inventory costing method, the amount of ending inventory will be different. So, for example, the cost of merchandise available for sale, remember, was $1,120. Our FIFO costing of inventory method was $422, which means our cost of merchandise sold that period was $698. Now remember, with FIFO, it was $422. With LIFO, it was like $380, and with weighted average, it was $402. So clearly, whenever this number changes, our cost of merchandise sold will change, which is why we need to make sure that we pick a costing method and stick with it. Now, this is important to remember, and I'm sure that there will be test questions about this, but it talks about, remember, that none of these prices for your merchandise is ever going to stay the same. So we always have something called inflation, and so there are periods of rising prices. There's also periods of declining prices. In a period of rising prices, the FIFO method is going to give the highest possible ending inventory cost and the lowest cost of merchandise sold, which means that net income is going to be highest under FIFO. When we have LIFO, on the other hand, LIFO gives the lowest possible ending inventory cost and the highest cost of merchandise sold, which means that net income is going to be lowest under LIFO. Okay, because remember, as the cost of merchandise sold increases, gross profit and net income decrease. So if you have a high cost of merchandise sold, obviously your net income is going to be low. Now, obviously, if we flip this and we say we have a period of declining prices, LIFO is where things are going to be looking best. FIFO is where they're going to be worst. Okay? So they're essentially just opposites, and you'll just want to remember that. And maybe it would help if we went back and looked at a net income statement so you remember how cost of merchandise sold essentially affects your net income because of gross profit. So if you need to go back and look at that, that would be a good thing to do. Now, the thing we have to remember is that all three of these costing methods are acceptable accounting practices. You can choose any of them. A business, however, should elect one method and then use that same method continuously for each fiscal period. Obviously, that goes with the accounting concept of being consistent with your reporting. We can't choose to do LIFO one year and then move to FIFO because you aren't able to compare it. If you do, however, make a change like that, if you decide to move from LIFO to FIFO, or you decide to move from FIFO to weighted average, whatever it is, you're going to have to disclose that when you do your financial statements, because part of either the reduction or increase in gross profit, which will affect net income, is going to partly be because you changed costing methods for your inventory. So this is just a comparison of the FIFO, LIFO, and weighted average. So you can see that our inventory at the beginning stays the same. Our net purchases are the same. Merchandise available for sale is the same. However, our ending inventory changes for each one based on our costing method. So you can see how the cost of merchandise sold is either $698, $737, or $716. Remember that weighted average will always be between the two. But then again, dependent upon if we have a period of rising prices versus if we have a period of declining prices. FIFO will be the highest and LIFO will be the lowest. So we'll just want to make sure that we remember those. Now, there is a fourth option that is out there, and it's called the lower of cost or market inventory, otherwise referred to as LCM. Because if you remember, we have something called market value, and market value is simply the price that has to be paid to replace an asset. And so when we use the lower of cost or market inventory method, essentially what we do is we calculate whichever is lower. We use that to calculate the cost of ending merchandise inventory. And when we are talking about this, we're talking about that cost refers to the actual amount paid for the unit of inventory, and market refers to the amount that must be paid to replace it. Now, when we do this, we still have to use or calculate either the FIFO, LIFO, or weighted average. We still need that, but we also need to know the current market value of our inventory. And what we do is we compare those two amounts, and then we choose the one that is lower to use as our amount to find our cost of inventory. Essentially, what this is used for is to try to prevent inventory values from being overstated, because that's a real fear when you're doing FIFO, LIFO, or weighted average. So essentially here you can see that when we're doing the LCM, the FIFO cost was $422. The market value is $405. So in this situation, we would use FIFO because market value was lower. In the LIFO method here, LIFO cost is lower at $382, market value at $405. So we would use the LIFO method again because it's lower. And again, when we look at weighted average, it was 403, market value is 405. So we would use the weighted average. We just use whatever is lower. Okay. So that one is, again, used to try to make sure that inventory is never overstated. But you do still need to do either your FIFO, LIFO, or weighted average to find your ending inventory cost. So that brings us to the end of the 20-2 lesson. We'll head over and do our work together amount as well.